You see these screenshots on Twitter. Someone buys a $2 call option, holds it for a year, and sells it for $1,000. 100x return. Everyone calls it a lottery ticket. But what if the lottery actually has positive expected value? Today, I'm backtesting deep out of the money leaps across 5 stocks over 8 years. We're talking 5 to 20 delta. Options that cost $1 to $5. Options that most people say are a waste of money. I tested 6 different deltas, 3 DTE windows, and 7 exit strategies across 120 configurations. Let me show you what the data says. Let's start with the headline numbers. Here's every symbol at 1 year out, across all 6 deltas. The first thing that jumps out, almost everything is green. Out of 30 configurations across all 5 symbols, only 2 lost money. Both were TSLA. Everything else was profitable. Deep OTM leaps are not lottery tickets. They are a positive expected value trade. Now look at the win rates. Even at 5 delta, the deepest out of the money options, the win rates range from 55 to 68%. That's not a coin flip. That's a statistical edge. NVDA at 20 delta had an 81% win rate with a profit factor of 8.29. That means for every dollar lost, $8.29 were made. That's the best risk-reward ratio we've seen in 23 videos. Profit factor tells the real story. NVDA 20 delta, 8.29. AAPL 50 delta, 3.69. SPY 10 delta at 1.5 years, 3.64. Even the worst performers had profit factors above 1.0. Compare this to Iron Condors from video 22, where TSLA had a profit factor of 0.54. Buying deep OTM leaps on TSLA at 5 delta had a profit factor of 3.45. Same stock, completely opposite results. Here's the most interesting finding. TSLA at 5 delta made $5,408 with a 64% win rate and a profit factor of 3.45. But TSLA at 10 delta lost $1,923, and 20 delta lost $4,076. How is that possible? Because at 5 delta, you're paying $1 to $2 per contract. Your max loss is tiny, but when TSLA rips 50% in a month, that $2 option becomes $6. The asymmetry is massive. At 20 delta, you're paying more. Your stop-loss triggers more often because TSLA's volatility shakes you out. And when it does go your way, the percentage gain is smaller because you paid more. For volatile stocks, go deeper out of the money. The cheaper, the better. Look at the full breakdown. 5 delta profitable, 10 delta lost money, 15 delta barely break even, 20 delta lost money. The pattern is clear. NVDA was the standout. Every single delta was profitable. The sweet spot was 15 to 20 delta. At 20 delta, 16 trades, 81% win rate, plus $9,123. Profit factor 8.29. At 15 delta, 14 trades, 79% win rate, plus $5,772. Profit factor 6.80. These are the best risk-adjusted returns in the entire Backtest Everything series. And remember, these options cost $5 to $15 per contract. But here's the real jaw-dropper. When I tested letting NVDA LEAPS ride without any profit target, the results were insane. The no profit target strategy with a 50% stop loss, 6 trades, 33% win rate, but plus $9,266. Average return per trade, 405%. Hold to roll, where you never sell, just keep rolling. 3 trades, plus $22,034. Average return per trade, 2,665%. One winning NVDA LEAPS trade returned over 8,000%. That's not a typo. One $2 option contract turned into over $160. This is what happens when you buy cheap options on a stock that goes parabolic. Now the ETFs SPY at 10 delta, 1 year out. 43 trades, 63% win rate, plus $1,628. Not as exciting as NVDA, but consistently profitable. Here's what's interesting about SPY. The 1.5-year LEAPS crushed the 1-year LEAPS. SPY 10 delta, minus 1 year out, 63% win rate, profit factor 1.73 to 1.5 years out, 77% win rate, profit factor 3.64 2 years out, 63% win rate, profit factor 1.43. The 1.5-year window doubled the profit factor. Why? Because you're buying more time for the trade to work, but you're not overpaying for the extra theta like you do with 2-year options. SPY 20 delta at 1.5 years, 70% win rate, $4,414 profit, profit factor 2.18. That's better than most iron condor setups. QQQ told a similar story. Profitable across all deltas. QQQ 5 delta at 2 years had the highest win rate at 74% with a profit factor of 3.20. QQQ 20 delta at 1 year, 36 trades, 67% win rate, plus $3,650. Boring, steady, positive. I tested 7 exit strategies for AAPL, NVDA, and SPY. The default was 50% profit target with 50% stop loss. Here's what else I tested. For AAPL, a 100% or 200% profit target made more money but with fewer trades. The sweet spot was the 100% target, $3,626 profit, nearly double the default. But for NVDA, letting winners run was life-changing. The pattern is clear. For growth stocks, wider profit targets or no profit target at all produce dramatically better results. NVDA's hold-to-roll strategy made $22,034 from just 3 trades. SPY tells a different story. The default 50-50 made $2,517, but the 50% PT with no stop loss made $2,319 with an 85% win rate and profit factor of 5.57. On ETFs, the stop loss barely matters because SPY recovers. So, what's the optimal deep OTM LEAPS setup? It depends on what you're buying. For growth stocks like NVDA and AAPL, Delta, 15 to 20, DTE, 1 year, 365 to 455 days. Exit, 200% profit target, 50% stop loss, or no profit target for maximum upside. NVDA 20 delta, 81% win rate, profit factor 8.29 for volatile stocks like TSLA, Delta, 5. Go as deep OTM as possible, DTE, 1.5 years, 456 to 545 days. Exit, let winners run, tight stop loss, TSLA, 5 delta, 64% win rate, profit factor 3.45. 10 delta, lost money. For ETFs like SPY and QQQ, Delta 10 to 20, DTE, 1.5 years, 456 to 545 days. Exit, 50% profit target, no stop loss. SPY, 10 delta, 1.5 years, 77% win rate, profit factor 3.64. If you combined all 3 approaches into one portfolio, here's what you get. NVDA 20 Delta 1-year calls, plus $9,123. AAPL 20 Delta 1-year calls, plus $5,699. SPY 10 Delta 1.5-year calls, plus $2,938. QQQ 20 Delta 1-year calls, plus $3,650, and TSLA 5 Delta 1-year calls, plus $5,408 total, plus $26,818 from options that cost $1 to $15 per contract. With a combined average entry of about $5 per contract, that's roughly a 50x return on capital deployed. Now, the reality check. 3 things you need to know. First, TSLA at 10 and 20, delta lost money. Wrong delta on a volatile stock and you bleed out. The volatility shakes you out of positions that would have been profitable. Second, entry pricing on deep OTM LEAPS has wide bid-ask spreads. A $2 mid price might have a $150 bid and $250 ask. That's a 40% spread. In the real world, you're paying more than mid and selling for less. Third, this only works on stocks that went UP over the test period. AAPL, NVDA, SPY, QQQ all had strong uptrends from 2016 to 2023. In a sustained bear market, every configuration would lose money. The biggest caveat: survivorship bias. I tested the 5 most popular tickers, and 4 of the 5 were in massive uptrends. If I tested stocks that went sideways or down, the results would be very different. Deep OTM LEAPS are a directional bet with leverage. The data says they're positive expected value on uptrending assets, but you still need to pick the right direction. Here's what we learned. 1. Deep OTM LEAPS are not lottery tickets. 28 out of 30 configurations were profitable. 2. The sweet spot for growth stocks is 15 to 20 delta, 1 year out. NVDA, 81% win rate, profit factor 8.29. 3. For volatile stocks, go deeper. TSLA 5 delta worked, 10 and 20 delta lost money. 4. For ETFs, buy 1.5-year LEAPS. SPY 1.5 years blew away 1 year with double the profit factor. 5. Let winners run on growth stocks. NVDA's unlimited upside strategy made $22,034 from 3 trades. 6. Bid-ask spreads and survivorship bias are real risks. Don't risk more than you can lose. This was the most surprising backtest in the series. If you want to see me test deep OTM LEAPS on more stocks, smash the like button and I'll run it on the top 20 tickers. Subscribe for the next video.